pockets which are likely to get impacted for till the point in time you have this 50% tariff. Now, the moot point is how long can this last? I mean, and you have to make some presumptions out here. I would believe that, US has a lot of investments into India. And this 50% tariffs mean that basically it is a sanction. And all of these guys are likely not to export anything with 50% tariffs. And by and large, if they have to absorb the entire 50% or even 25%, basically the margins are not going to come through. So particularly textiles, etc., they operate at single-digit margins. And if the buyer asks you to absorb 25% of this 50% tariff, obviously you can't run your business in a loss. Similarly for other sectors. So all in all, I would like to believe that this number of 50% will get whittled down somewhere down the line. You don't know when, but likely in the next 3 to 4 months to anywhere between what other countries are paying. By and large, 15 to 20%. And electronics, pharma, specialty chemicals, these are some of the areas where a lot of exports go to the US. And mind you, there are going to be shortages, and supply chain cannot be really catered to on the alternative side in a hurry. And so I would believe that from a market point of view, nothing much to worry about. Assume that $60 billion, half of that will get whittled down. In terms of impact, $35 billion will have to find a new market. Government will do its bit in terms of helping the exports to other markets. RBI will do its bit in terms of lowering further rates, enhancing liquidity. And, that is how this whole mitigation of the tariffs is likely to play out. As it is 1.5% to 2% on GDP, the growth rate, 50 basis point, will be taken care of by incentives given by the government and the central bank. So I would believe it is a buy on debt market, buy at 25,000. There's nothing much to lose on the downside.
Okay. Mr. Manish, hi, Mahima also joining in. Just want to understand, considering the kind of year-to-date performance that, we've seen in terms of the benchmarks as well as the broader markets, what are you suggesting your clients right now to do? Are you keeping dry powder right now to maybe, see the right point to enter? Or are you deploying your money? And if yes, where are you deploying it?
So don't look at the broader markets index per se. Focus on individual stocks. That's the best way to go about it. I think if you look at the headline indices this year plus next year, average should be around 10% growth. And you couldn't give a better multiple than 22, 23 times on a 1 year forward basis, given the anemic earnings growth of 10 to 12%. Broader markets, again, the Nifty 150 mid cap, all it's in NSE small cap 250. You have to buy that 25, 30 odd stocks. There are ample stocks which are growing at 25 to 50%. There are also stocks which are growing negative. It's a pick and choose sort of a market. Focus on domestic themes. 77% of India is basically domestic. We produce and consume assets. Some of the areas like pharma, CDMO, etc., we have a right to win. IT probably has seen the worst. Real estate is swimming in the economy is swimming in liquidity. Credit demand in the system is not that adequate given the low cost of capital. Will find its way into speculative demand. So real estate, capital markets, all in all, these are NBFCs to say the least, and public sector banks. Now the private sector bank, because this quarter, first quarter, has seen a bit of stress building on to lending financials balance sheet. MFI in any case was a worry. You still have another 2 quarters to go, for the full provision to come through. So there are certain pockets which look okay. Valuations is something which one needs to keep an eye for. This is the only big worry in the market. Not everything is viable. Not everything is sellable. I think if we stick to reasonable price earnings growth multiple, given that markets today are trading at 2 times price earnings growth, there's ample room to pick and choose.
Got it. Manish, Harsh joining in. If I were to venture more towards IT and try and understand what it is that is in store for the IT sector and the space as a whole, there's just so many moving parts. So trying to understand possibly 25, maybe even a 50 basis point rate cut, would that be enough sufficient to drive the sector earnings and growth? Would that make a comeback likely in the next year?
So basically, the mid-tier IT companies are likely to fare better than large-cap IT companies because the buzzword is today AI disrupting jobs, and large-cap IT companies are hiring maybe 500,000 or thereabouts sort of employees, and all of them are not reskillable because if AI is to disrupt segments of the IT, then people needs to be retrained. This is more doable in the mid-cap IT names. They would be more nimble-footed. And from that point of view, mid-tier IT companies' growth should be better than large-cap IT companies' growth. Not to say the least that order book positions for both large-cap and mid-cap IT companies are swelling. It's just that execution has been in a limbo for some time due to the slowdown issues facing the developed markets. But valuations at the same time have corrected significantly. And I think from this point of view, from looking at this lens, we think that there is ample margin of safety in the IT names. Whatever correction had to happen has already happened. And given that on a one-year forward basis, these are trading at lower than historical valuations, are we venturing out more in favor of mid-tier IT companies than large-tier?
Manish, one final question. You attended a clutch of investor conferences, I presume. It is still the conference season. What has stood out? Last year, you had told us about the recycling theme, if you will. What has stood out this year?
Consumption. If you speak to entrepreneurs and, the conferences that we attended, ask one simple question: what do you make of the tariffs? They said that, everybody is gung-ho on the domestic market per se, more so after, our Prime Minister has announced his GST rate cuts. I would believe that consumption is going to come back big time. Last few years, especially post-pandemic, it is all about investment-related themes, right? Whether it be power, whether it be renewables, whether it be defense, railways, capital goods, valuations have gotten very full. This time around, the heavy lifting of growth for the economy, the 6% or 5.5%, given the impact of tariffs, will be done by consumption. Last 2-3 years, consumption has not done well because of very high inflation, very high taxes. That is moving at the margin in favor of the middle class. So all middle class related consumer is likely not only to see earnings boost, but also valuation re-rated. So from that point of view, automobiles, we already started seeing re-rating, fast fashion, QSRs, leisure, travel, hotels, a whole lot of them, health insurance. Some of these areas, the conferences, people and managements are quite optimistic.
Okay. Okay, Mr. Sonthalia, thank you so much for giving us those insights. And clearly, consumption is a theme to play, and the markets are cheering that today as well. The defensive play is doing its role. Thank you so much for taking out the time and speaking with us at NDTV Profit. Let's shift focus. Key ministers are likely to meet PMO at 3 p.m. ahead of the 50% tariff hit. Rishabh joins us with more details on that. Rishabh, what is the agenda?
Right. The main agenda of this meeting is expected to be a review of the export promotion mission that was actually announced in the budget in February and hasn't been launched yet. But what we're hearing is that it could be launched with a 25,000 crore rupee outlay. Now, remember, this comes with two sub-schemes. One is Niryat Protsahan and one is Niryat Disha. Under Niryat Protsahan, the main vessel of support for exporters will be export credit finance. That is number one. And under Niryat Disha, you have targeted support for